Hey everybody, happy Sunday. I know the markets are closed tomorrow, but I'm doing a little bit of homework here today. Pacing myself, I'll be doing more homework going into tomorrow evening, but welcome nonetheless. Welcome to our weekly Notes live show. Great to see everybody. We'll be covering most of your questions today. I'll do a lot of Q&A for the next 30 minutes or so. And as far as market prep goes, we're going to focus a little bit on the economic calendar here today. And, well, we'll just dive into your questions, do a really thorough Q&A today. It's kind of a rainy, really rainy, overcast Sunday today, and perfect time to do a little reading. Saw Top Gun today. I saw Top Gun Maverick. No spoilers, no spoilers. Watched the Formula One race. Also, no spoilers there. But just kind of chill. And I hope everyone's had a kind of a relaxing weekend. You know, we've got a lot coming up over the next couple of weeks. We've got non-farm payroll coming up towards the latter part of this week. So, you know, keep in mind, you know, the shenanigans begin June 1, which is Wednesday, where we start to get a little bit more meaningful data. We've got Chicago PMI and consumer confidence numbers on Tuesday. They could be slight needle movers, but remember, we as market participants, investors, traders, we know that what we have coming up this week is very much geared towards what is a jobs picture going to look like. I think that ECB President Lagarde speaking on Wednesday will be a big one too, because that's been moving the dollar, the hawkishness out of the European Central Bank as they're going to come out of those negative deposit rates. That'll be another one to watch. But Wednesday, we've got the ISM manufacturing PMI, JOLTS job openings. We've got Williams. We've got Ballard speaking. Going into Thursday, because we have the Monday Memorial Day holiday, ADP gets moved to Thursday. So heads up, ADP kicks in on 8:15 on Thursday as opposed to Wednesdays. And we have OPEC meetings. So if you've been looking at RBOB gas, heating oil, crude oil, OPEC meetings begin this week. And then, of course, we've got non-farm payroll. And that's going to be the big number for this week, as PCE was for last week. That inline PCE seemed to keep a relatively low volume rally going into the end of this month of May going, and we'll continue to see just how much more the downtrends that are actually intact in the indices, how much higher will they retrace? I mean, that's kind of the question that we're going to be asking ourselves. So let's dive into the question, shall we? And first up on the questions. All right, let's move this chart out of the way. There we go. All right, Mark, how are you? All right, some companies reported bad earnings due to inflation. Do we just check PCE and PPE reports, or are there better ways to track inflation? CPI and PCE. And you can look at both of those on a graph, so you can chart each one. As far as company earnings, keep it on the dollar as well. But I track PCE and CPI. That's the way that I track the way. Now there are other numbers that would kind of filter in below those being the main sort of headline, the main needle movers. But there are other numbers below that will contribute. But if you want the easiest way to do it, rate of change on I would say the CPI and the PCE. All right, next up, Integral asks, how would I compare exhaustion trading to momentum trading, and why do I prefer exhaustion? Thank you. All right, so Integral, I kind of compare it like this: chocolate ice cream and vanilla ice cream. Ice cream is pretty awesome, whichever way you want to go, whichever one suits you, whichever one tastes best, right? Now, that's the second part of your question. I think it's a matter of preference. There's no reason to say tactically it's incorrect to go with momentum, or tactically it's incorrect to go with exhaustion. What I will say is in a trend, both work. In a trend, I can buy the dip, which is finding an uptrend, letting the market retrace to support, and then buying that. A momentum trader might buy a new high in the direction of the overall market. They might wait for the market to retrace, and then on the way back up, they'll engage the market to the long side. So that's sort of this buy the dip. You can also wait for the dip and then buy into the rip, buy into that rally. So it's not necessarily a directional disagreement between exhaustion and momentum traders. I don't think it's that momentum traders are thinking short and exhaustion traders are thinking long. I don't think it's a directional disagreement whatsoever. I think what it is a timing difference. And my preference is, well, to buy things on sale. My preference is to wait for that retracement, likely because one of the earlier strategies that I was exposed to, aside from Dow theory, was Fibonacci. And Fibonacci is an exhaustion type approach. You find the retracements, the market makes a 38.2, 50%, 618 retracement, and buying into that retracement is exhaustion. And so I think just what I was exposed to early on in my career just probably pushed me in that direction. And again, vanilla versus chocolate. I like vanilla. I like exhaustion trading. So that's really the way I look at it. I hope that covers it. I don't think it should be ever a comparison of good and bad. It should simply be a comparison of which resonates with you. All right. Thank you for the question. All right. Next up, Nick, how are you? Do I sell options? Habitually, no. No, very seldom. Very seldom. I've heard professional traders often sell more options than they buy. I've never, so the word professional, in the context of trading, let's talk about that word for a moment, which you will never hear me refer to myself as, because the word professional actually is a designation in our trading world. So when you're filling up your brokerage application, right? Futures, stocks, what have you. One of the things I'll ask you is, are you a professional trader? And there's certain criteria that will make you a professional trader. And then you have actually higher exchange fees in some situations, but it is a different standing in this world, this market world that we're in. So in that regard, with that definition, and I don't know if it's I don't know what governing body determined that in the first place, but I am not, by way of that definition, nor do I want to be, am I seeking to be. I am not a professional trader based on what I know about what the criteria is. So, I don't know what other traders are doing, professional or not professional. But yes, not only do I hear that, Nick, I hear that they say, if you're not selling options, if you are not an options seller, if you're not a net seller, premium collector of options, you're destined to lose. And I believe that to be categorically wrong. Anytime we don't control risk, anytime that we prioritize reward over risk, anytime we lack timing and respect for the trend, I don't care what type of option trading someone's focusing on, collecting premium, writing options, or buying options, as I do 99% of the time. If we don't have a respect for risk, direction, and timing, there is no strategy where, well, I sell options and therefore I don't need any of those things. So I think regardless of what type of trading with options we want to pursue, direction and timing and risk are inextricable from a productive trading life. So yeah, I hear a lot of them do too, but that's my take on it. That's my take. And that's just my opinion, right? But the one thing I will say that is not just my opinion is, if we don't prioritize how to control risk, if we don't accept that we are going to lose, if we don't manage to build positions with the main idea in mind is, what if I lose? And then remember that trading and losing is part of the game. I mean, we're going to lose as traders. But then, I retweeted this on my Twitter. Not that it's easy to do, right? Not that it's easy to do. I'm checking my Twitter to see if I posted it. I think I did. Let's see. Twitter. There I am. And there it is. The big secret to this business is losing the least amount when you're wrong. And I don't know what that magic least amount is, because this is borderline fortune cookie trading wisdom where it sounds good, but how do we do it? In my mind, how we do it is going to be slightly different from trader to trader. What's your account size? How many positions do you have open? How overlapping in terms of correlations are those positions? Are we coming into a major hot zone of high volatility, high impact? Um, so those are things. But if I know where my stop loss is, if I know where what my budget for each trade is, I'll have a better shot at losing the least amount when I'm wrong. And that's always what I think about building my trading plans upon. So I hope that helps. And thanks for the question. All right, next up, what about CSX? Sure. Or a short? Double red downtrend? Absolutely. So CXX, if we're looking at CSX, I'm going to do what? I'm going to think about comparing CSX to, say, the IYT, XLI, right? That's going to be my thought. Let's see here. Let me see if I can. Yeah, I think I can change this here. Where's my ticker? There we go. So let's say I want to compare it to IYT. And what kind of trend? This is boats and tide, gang. What kind of trend is IYT in? Let me show you. Let me grab my drawing tools here. Okay. The top two rows in this indicator that I have down there, the top two rows, that's CSX. The bottom two is IYT. The first one is momentum. The second one is trend. Same thing with IYT. First is momentum. Second is trend. And so if I have an outgoing tide at the IYT level, and I also have an outgoing tide at the CSX level, yeah, I like the idea of a short, because that's a really great collaboration, if you will, of boats and tide. That's a really great confirmation that the individual boat is moving with that broader picture, that tide. And that's personally what I like to see. Are all my trades going to be that way? I won't always have that. Sometimes I'm looking for relative outperformer. Sometimes I'm looking for the outlier in the trend. Not very often, but most of the time I want to see either the best downtrend in a downtrending tide or the best uptrend in an uptrending tide. Rarely would I want to find the outlier. In other words, rarely will I want to focus on an uptrend in a downtrending tide. In other words, a boat that seems to be trying to head higher while the overall tide's heading lower. That I don't want to do a lot, but I will keep an eye on both of those. All right, next up is Nike. All right, so looking at Nike, well, let's do the same thing. So in this case, we're going to compare Nike to the XLY, consumer discretionary. All right. First two rows of Nike, momentum, trend. Then XLY, momentum, trend. Consumer discretionary is heading lower, Nike's heading lower. And really what happens here is I'm comparing one stock to the sector that it's in, one boat to the tide. It also makes sense to crack open the XLY and find all the heavily weighted stocks within it. Amazon, Home Depot, Tesla are your top three. And then Starbucks is in there. There's a number of other names in this group. All my cards on the table. I like XLY to the downside. And I have an open position in Starbucks to the downside. And a lot of traders for the first time, especially traders who followed my setups and my trading during the double green uptrend of, say, even 4, 5, 6 weeks ago, it's distinctly different the way a downtrend behaves. It's much, much tougher. It's much more volatile. And I think for a lot of traders, this might be their first foray into engaging downtrends. And it's hard because bottom picking and the FOMO is so much more intense for traders trying to find and front run the low in a downtrend than comparatively traders trying to front run and find the top in an uptrend. And when that low holds and there's a little bit of momentum and a little bit more momentum, the degree to which the FOMO kicks in is intense. And just as an aside, because I was talking about this very topic, I think in a free video, but certainly in my mastery, and I said, look, right now, no doubt about it, this environment is difficult to trade. I would say this is even a little bit more volatile than most downtrend bounces. This one's been pretty intense. Now, if someone said, Rob, what do you think the market's going to do? I try not to say think. I try to say, well, what direction was it heading? And is that structure still valid? And I take that index by index and sector by sector. NASDAQ is a pretty easy one to say, yeah, it's still looking quite clear that the downtrend will continue. S&P, maybe not as much. Dow, maybe not as much. But then I can go down to the individual sectors, XLK, XLC, XLY, and do the same thing. So it makes a lot of sense to find the best example of a market that's holding the most visual confirmation of the downtrend still being intact. Red grab candles, the red momentum trend of the multi or the trade flags, staying at or below the wave. What's up, girl? My pup is in the. Oh, you wanna? She. Oh, you can kind of see her. There she is. There's the pup. It's thundering something awful. We've got some pretty wicked weather rolling through. And for whatever reason, she wants to hang out in the office whenever that happens. So a little cameo from the pretty girl. Okay, so that's the way I would look at breaking it down. And I like Nike, but Groot, take a look at the other stocks and make sure Nike's the best example. And if you get a shot at the XLY itself, why not go that route as well? And yeah, Starbucks, ditto. All right, let's see. What are my thoughts on Salesforce? Downtrend. Vinny, this is short the rip. This is wait for a retracement. Sell into a rally. Maybe wait for the 21 propulsion. A little bit of a volume ledge at 164.20. And that's what I would look to take advantage of. Look at that volume right there. Pretty much where in the upper, say, third of this candle, you can see all this volume stacked there. 21 exponential, where I used a simpler propulsion tool for that, which, by the way, is free. You can grab it over at countdowntrader.com, or there's a free layout that I share with members in, I think, all the main rooms: day trading, training, options, futures. Of course, my mastery, we have a slightly upgraded one, slightly hot-rodded layout for those of you in the mastery. But propulsion's included on that. And if you don't have access to any of our rooms, I highly check out what we're doing. I highly recommend it. Take a trial, come check out what we're doing, or head on over to countdowntrader.com and you can download that for free. So that's what I would be looking at, Vinny. It's a short the rip. It's a short the rip. Okay. Next up is QQQ. Now, again, whenever I'm looking at the market and saying I like this for a short or I like this for a long, everything, and we should hold ourselves to this standard. Not what we think, not what we heard someone say on television, not what we feel. Oh gosh, please, not what we feel. As if our colons are making the decision about what we're doing, our gut. It should be, what are the tools that we have consciously chosen to plot on our charts, and what are they communicating? Is what they're communicating clear, or is it a little fuzzy? Is there more than one reason? Is there more than one confirmation for the continuation to the downside, or the continuation to the upside, or expecting resistance, or expecting support? And so everything that I'm sharing with you all is just built on what is on the chart. And then based on what's on the chart, much like we would look at our speedometer on our car to say we're going 50 miles an hour. I wouldn't say, well, no, it feels like, I think. We would just look at the speedometer on our car and go, I'm doing 50 miles an hour. And we wouldn't do all this other, these other machinations. So same thing. I'm just reading the speedometer. I'm reading the gauges, right? I don't say, well, I think, the way the car's handling, I think I've got a quarter tank. No, I look at the gauge. Otherwise, I'm going to get stuck on the road when my tank is empty. So I always want to rely on what we see. And any opinion that I have should come from that. Anything that I'm going to do, what I see is going to map to what I do. So what I see, I don't look at 4 hours, Samir. So that's the other thing too. You see a 50 MA on the 4 hour, cool. This has been a good spot. What do I think? Samir, I'll be straight up. I have no clue. I don't use that consistently. I would hate to tell you no or yes, because I don't know, my friend. That 240-minute time frame is not one that I look at. I look at a 5-minute when I'm day trading. I look at a weekly when I'm building my longer term position trades or portfolio. And I look at a daily when I'm looking at overnight positions. So if you see, kind of going back to what I said, Samir, if you see based on your tools that the criteria for what would make you believe that visually you can confirm resistance or support or what have you, frankly, it doesn't matter what I think at that point, because now you've got a process. And I think it would be one part irresponsible and one part arrogant to say, well, my process is better. Because, I can't compare my process in a daily to your process in a 4 hour or even a 30-minute or 60-minute or what have you, right? Now, if we were comparing daily to daily, I might have something more to help you out with. But when we have different time frames, I think it's really important to respect other time frames and say, well, I don't have that on my radar on a regular basis. And that comes up a lot when people ask me about a 30-minute time frame or a 1 hour time frame. And I just got to say, I don't look at it, but as long as you can go back to process, I think you can at least, if nothing else, trust what you see and control risk, right? Okay, so next up is the Russell. Sure. So when it comes to Russell, much like many of the indices, we've had such a strong surge to the upside. Call it a short squeeze, call it a rally, call it a bottom. I don't know what it is, and frankly, nobody else does either. We're just gonna trade what we see. I would, for now, and I kind of was alluding to this earlier, so I'll finish that thought. As I am looking at the current market, and less looks clearly up or clearly down, I'll either lengthen my time frame out to say, what are those stocks that have been on my wish list for months, if not years, and I've been waiting for some kind of significant correction, retracement, use whatever word you want, and I've been wanting to buy, a stock like Amazon or what have you. It's funny how excited people are to buy Amazon at 3,500, but nobody wants to buy it at 2,300. I want to step out and say, hey, when's the last time I had a chance to buy Amazon at 2,300? Or maybe my number is 1,700. I don't know. But, I think the two ways to handle what we're seeing right now is either go way long term and ask yourself on a longer term time horizon, longer term time frame, what are those wish list numbers? Or, what I like to do over summer, this is just me, and probably a lot of you as well. I like to shorten the time frames and say, you know what, rather than expecting clarity of structure day after day after day, maybe it's time just to say, look, I don't care if I have structure day after day or week after week. I don't need it. I'll shorten the time frame and look maybe 30 minutes, 60 minutes, an hour, 2 hours of clarity. All right. You want out of the room? Oh, hang on, gang. The pup one's out of the room. All right. The pup doesn't realize we have a show going on. All right, pup. You need to go to the bathroom or something? Come on, girl. Come on. Why don't you go? Why don't you go? You want to come in, Kat? All right. Come on, Kat. All right. I got the pets. The pets don't care that there's a show going on. They just don't care. So I will either lengthen the time frame or shorten the time frame if the time frame that I prefer is frustratingly lacking clarity, right? And I think there's a lot of power in stretching that time frame out or truncating it. And for the Russell, SWS, I would shorten it. Just maybe be a day trader on the indices for a bit, right? And then that would apply to the IWM as well. Day trade the options on that, or jump out to the weekly if I don't trust that I have an uptrend, which I see based on my indicators that I don't, but I don't have quite the same clarity on the downtrend any longer. So that's what I mean by lack of clarity. Weekly might look different. Daily. So here's my weekly. So do I have clarity on the weekly? Am I hitting a number that I want to see? There's my daily. And if I don't like it, I can just shorten it and go to the 5. All right. Okay, next up is what would be resistance in the QQQ based on this rally? Well, we'll start at the wave. Let's also get in 2022. And I would say you have about 313, 319 and a half. Those are 2 volume ledges. And I would say that's what I look at based on volume ledges. And then the wave itself, anywhere from 307 to at 316.80, call it. Now, if I can find a number of reasons stacking at the same time, or the volatility peaking with a specific hot zone, right? We've got ADP, we've got non-farm payroll, we've got a number of potentially interesting hot zones, but I like levels inside. The one that's probably going to get my attention the most would be the middle line of the wave and that volume ledge. And if we closed so strongly on Friday, one of my rules is don't fade a Friday. I don't want to fade any close, but definitely don't want to fade a Friday. So I would not be surprised to see on Tuesday a little bit more strength. I wouldn't be surprised whatsoever, because again, that FOMO is going to be still, raging on. And so that's going to make it a little bit more painful for traders who are both macroeconomically and technically still more bearish than we are bullish, and maybe more bearish to neutral right now. And it's going to be a little bit more painful, which when it comes to downtrends, it's just sort of par for the course. What are my thoughts on Amazon? Nothing. My thoughts, no, it's a downtrend. It's a downtrend. So everyone knows, Trader Louise, everyone knows that split is coming. I'm actually kind of impressed that it's not rallying in front of the split, because it's hilarious to me when investors want to buy a stock in front of the split. And maybe retail investors are finally learning I could buy it pre-split, or I can buy it really for the same price post-split, right? Because all it's going to do is get cut, as you showed, 20 to 1. But the price is still more or less the same. But what's interesting about post-split is that there's typically an extra bit of pullback. And so very interesting to see. For example, remember Tesla pre-split? And then that made no sense. Anytime a stock rallies on a split, that's just people who can't do math, or just the hype, right? The psychological hype surrounding, oh my gosh, the stock's going to split. Buy it after the split, right? Whether I buy 1 share now or 20 later on, it's more or less going to be the same. And history has told us that buying it after usually comes at a bit of a discount. Now, because there is a lot of volatility around that, maybe it does rally. But again, it's a well-established fact that it's going to split. And so I don't really look at it as something that would necessarily be bullish, quite frankly. I mean, it's in a downtrend. So my thought on it is, first and foremost, it's trending lower. And if it continues to trend lower, right, would it be different trading when June 6th, becomes I would think it's going to be more affordable, is what I hope. That's what I would love to see, that this becomes more affordable. And then that means that it's scalable, small and medium and large and Godzilla-sized accounts who are probably trading it anyways. It's going to be more accessible to a larger group of traders. That would be great. But I'm not going to play it bullishly because of the split. I'm going to actually look at what it's doing right now on the daily. And that is a pretty well established downtrend since about the 6th of May. That's a pretty good downtrend there, gang. All right. Okay, so I'm still debating on whether I'm going to do charts and coffee tomorrow morning, but I'm thinking I will. I'll get my notes out likely if for those of you that are members. I'm going to work on the notes tomorrow and kind of enjoy this slightly longer weekend coming up. But think about lengthening the time frame if this environment's frustrating, or shortening the time frame if this environment's frustrating. Don't feel the need to have to trade right now. It's summer. It's a very volatile downtrend. We still have a lot of confusion and curiosity about what the Federal Reserve is going to do next. Fed Fund futures tell us we're going to see a half-point hike in both June and July meetings, and likely another quarter in September. So it's hard to make bets on the Federal Reserve pausing between now and September. Probably very much not the case, right? So those are things to keep in mind, and I'll stay the course from a macroeconomic standpoint and just accept that these sort of much more violent corrections, retracements of downtrends are just the nature of the beast, and this one has been a beast. So enjoy the rest of your day. Thank you as always for tuning in for our Sunday Weekly Notes Live. Love chatting the markets with you all, and I will see you all likely in charts and coffee. It's a good habit, right? Just to take a look at the markets together. So until then, gang, be good to each other, and I'll talk with you soon.